the biggest upside to traveling off the highways onto the main roads? It means you've almost reached your destination. There are just a few more turns you may have to make to reach it. And this is what I like to think when I drop down in time frames. The need to go from a bigger and wider overview of my path to a smaller and closer view of my entry. Hi, my name is Shaquan Lopez, and in this video, I'm going to be showing you when it's the appropriate time for you to drop down in time frames to execute trades on a lower time frame. Now, before we get into the video, I'd like to welcome you to my trading space. This is a discussion for swing traders or traders who are looking for a safe community to learn, be transparent, and feel welcome to come as you are. So let's get into the video. Now, I'll be using TradingView to showcase my charts and the price note tool for time frame purposes. If you've yet to use the price note tool, I've created a video that teaches you how to use it to identify exchange rates on your own price chart. I'll link the video above. Now, there are a few steps in between you dropping down in time frames. That's actually the last step. So let's cover the first. I like to call this first step the highway. What I love about highways is the ability to drive fast, switch lanes, and the ability to not get stuck in traffic or red lights. When I think about my certain time frame, I think of the one that allows me to see movement of candlesticks with less confusions, distractions, and stopping points. That time frame is the weekly. Each candle displays 5 days worth of movements, which is 5 days worth of bank transactions between buyers and sellers of said currencies I am potentially wanting to trade. The best way for me to make a decision is to know if the pair I'm wanting to trade is flowing well and can provide me an opportunity that where I won't get stuck or is it moving. This is the analyzing stage. And what I like to do here is find my recent highs, my recent lows to determine the true movement of price. My eyes are not just fixed on one individual candlestick to tell me the story, but on the visual flow of movement of a group of price action candlesticks. So let's take this time to look at the weekly time frame on the Australian dollar, New Zealand dollar. I'm using this pair as my case study beginning the first week of June 2020. So what's important to note here is that we have to look at the flow of price. And what I want to first start to view is, like I said, what do I already know about this currency pair? So I can see that price had made a high here at $1.08 New Zealand dollar. So now what I'm looking at is, let's break this down further. Let's see what this means even more. And what this means is that at this point in time, for the people who live in New Zealand who use the New Zealand dollar, the highest price that they would have bought for this week of June 1st would have been $1.08. If we round it, we could say $1.09. But does that mean that us as a trader, we should buy it? To be honest, no, because it's a high price. The next thing that I'm going to look at is I'm going to look at the fact that price could not pass the wick here that week of $1.08, but I'm also going to notice what type of candle this is. I like to call this the inverted hammer, and it fits in the rejection candle categories, such as the inverted hammer, the pin bar, the morning star, the shooting star, whatever you call it, is in that one category, okay? So this is the candlestick that helped push price down. So now when I look at the flow of price, I'm looking at the group of candlesticks and how they kept going further away from $1.08. So now when I look at where the low is, now I'm going to look at the candlestick again. So now I can see that price created another inverted hammer the week of July 6th. So a month later, we get that same candle. Not only that, but we also get a bullish engulfing candle, which means this green candle is bigger than the previous candle. So that signals that the buyers could be coming back into the market. So I'm also looking at the exchange rate, which is at $1.56 or $1.05 or $1.06 if you want to round. And what this lets me know is that the bullish engulfing told the story that price will be getting ready to push up. And now when I look at the group of candles afterwards, I can see that the group of candles actually pushed up, 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 up for the next month or so. So what happens is now price has made a new high at $1.10. So now what this means is that the people in New Zealand, they're now buying the Australian dollar for a higher price. Instead of them buying it back at 108 or back at 105, they're now buying it back up at 110. This is where me as a trader comes into play, and I ask myself as a trader, well, I want to buy at a new high. I do not want to buy at a new high. I actually want to sell this information and sell it to a discounted price. This is what I mean by discounted price. Instead of the people who live in New Zealand buying the Australian dollar at 108, the best price for them was around 105 and higher, but lower than 108. Now that price is at $1.10, and I'm noticing the candlestick that price is attached to, it's another inverted hammer because the wick is longer at the top and is shorter at the bottom, and the candle body, the rectangle or the square, however you see it, is located more so towards the bottom of the candlestick, right? The wicks. So now in my mind, if price can stay below $1.10,440, I want to become the seller and counter trend this for profit and trade to a discounted price that can stay above 105 because now the market is trending. So this is the market structure stage, or what I like to call the bridge. The bridge just basically means that we are now going to use the type of structures that we use in order to be able to execute a trade. Now, I use supply and demand, and I use zones. I call them my estimation zones, where I estimate that where I want price to stay below so I can enter a trade. That's what the bridge is for. You're entering the bridge, and then you're going to have an exit from the bridge, right? So you may use a trend line, you may use support and resistance, whatever the case may be, you use that structure, but now because you're the seller, you'd want price to stay below $1.10,440. So now we put together, what do we know once again? We know that 110,440 is what's called a higher high because that high price is higher than $1.08. We know that this is too high to buy, and so we'll sell it for profit. We also know that anything below 110 and where we put our structure is where we want to enter the trade for a sell. All we now know is price needs to stay below this one candle. So whatever structure you're using, the reason why it needs to stay below this candle is because it's attached to the highest exchange rate. So that means that we don't want price to touch 110,440. We want price to stay below it. So let's go to a lower time frame now to find the entry. Now, one of the reasons we're going to go to a lower time frame is because who's going to enter on the weekly time frame? Most traders do not. Now you're going to be entering more into the position trader mindset. A position trader is a person who holds the trades for months, for years, and there are position traders in the Forex market. You may not be a position trader. You may be like me, who's a swing trader, and yes, I am attempting to become a position trader, but you may be like me who likes more short-term swing trades or mid-term swing trades, or maybe I'm holding trades for a few days or a few weeks or even a few months if I have to. But let's get into the entry. So instead of going down to like the 1 hour or the 4 hour, I'm going to go to the time frame I primarily like to enter on, which is the daily time frame. Now, the reason why I like to use the daily time frame is because, for one weekly candle represents 5 trading days. So that means for me, the closest entry that I want that doesn't have too much movement when I drop down, where I can visually see what's going on, is going to be the daily time frame. So I only have to show up 15 minutes a day. Imagine showing up 15 minutes a day to enter a trade, and then you just let it go. Imagine how much more free time you will have, and you'll be able to catch more pips. That is why I like to swing trade and use a higher time frame for a combination as a swing trader. So now what I'm going to be looking for is for price to stay below that rejection candle. So as price continues to move, remember, we want price to stay further away from $1.10,440. Now, you may trade breakout rules. You may trade breaking retest rules. Whatever your rules are, that is where your strategy comes into play. That is where your rules come into play. I don't really like to say that price breaks things. I like to say that price pushes past price. So as you guys can see, where I have my arrow, price push past 1.09441. And it's further away. So if price can come back to retest or to give me one of the candlesticks that I like to enter on, which is only 4 that I primarily look at, then I'll be more inclined to want to take a trade. And as you guys can see, price tested that number multiple times, and then we get a bearish candle. This is the closest price that I believe tests the rejection candle that will allow me to get a closer entry that makes sense for me, that will have me in minimum drawdown, so that when price that continues to decrease, I can continue to be the seller. Now, where your exit point for being a seller is, that is completely up to you, because exits are personal, stop losses are personal. The purpose of this video is just to give you an inclination of when to drop down in time frames and how to drop in the time frames. So I went from the weekly to the daily. So I went from an analyzing time frame to an entering time frame. So let's go over what we know one last time. One, we know that $1.10 was a high price. So that means that we want to become the seller for profit. That means we're also countering or counter trend trading per the weekly time frame, because as you guys can see, price was in an uptrend. The moment that price made a new high at $1.10, that proved that price was in an uptrend. So we're actually trading the pullback. That's what makes this a counter trend trade. Not going to enter on a weekly time frame, so we're going to drop down a time frame, which for me is the daily. It may be something else for you, but I like using time frames that are closely related, such as monthly, weekly, daily. Overview, overview, entry. Overview, entry, if that makes sense when it comes to time frames. So grouping my time frame into threes versus having the fourth time frame, fifth time frame, sixth time frames actually allows me to eliminate extra decisions that I may not want to make, or that may cause me to use more time and energy to focus on a trade. So I like to use the overview entry concept in order to enter a trade, weekly to daily, or monthly, weekly to daily. So then we're going to apply our structure below the highest price of $1.10. So once we drop down in time frames, or once I've dropped down in time frames, I'm just now looking for an entry to retest the area, or push past the area, to test it and push past the area further away from $1.10. For me, it was the bearish engulfing candle, which would be where I would enter the trade. Now, once again, like I said, the exits, which are your stop losses and your take profit, will be personal to you. But once I've entered this, because it's a longer term swing trade, I can now begin to see how price moves as a group once again to flow. And that is what we are looking for, because the flow is what can help us execute extra positions. The flow is what can help us determine, especially when you're in long-term swing trade, what price can go to next, versus looking for new trends and new directions every single week. As a swing trader, we're looking for one ultimate position, one ultimate direction to continue to stack the trades without having to flip through too many time frames to see what's going on. So I pray that this video helped you understanding the appropriate time of when to drop in the time frames, and the things that you could actually look for, and how to remember the rules and the established mindset of your market structure, which is the bridge, so you can enter your trades. If this video was very valuable to you and you learned something in this video that was plain and simple, I'd love for you to share that down below. Make sure you guys give this video a thumbs up. Make sure you like it, and I'll talk to you guys in the next video.